telling you this is one of the most critical videos and one of the most important videos that I've ever made, because this is what puts businesses out of business. It's what put me almost out of business years ago. It almost put my brother out of business 2 years ago. I'm working with a company right now, a very large, $50 million plus company, who's teetering on the brink of going out of business because of this right here. There is a massive mistake that you're making inside of your business. And I can promise with a high level of certainty that you are doing this in your business today. And the reason I can say that is because the statistics on this are that only 7% of all real estate businesses are doing this correctly. So if you are an investor, a fix and flipper, a current real estate developer, then I want you to listen and stay to the end of this video, because I promise you that I will teach you something in this video that you did not know. And if you did know it, you didn't understand the importance of it. So stick with me to the end, because I see this problem repeated over and over. I've started multiple 8-figure businesses. I work with 7, 8, and even 9-figure real estate developers, and almost all of us do this thing. Because the primary mistake that I see real estate developers making over and over, and it's not just my observation, this is not anecdotal, I looked up the statistics and only 7% are doing this correctly. It's tracking the numbers. It's tracking the numbers, but tracking your numbers in a specific way. So if you're in real estate development, or you're building homes, or you're flipping homes, you probably have multiple homes going at any given time, which means over here you have project number 1 that you took a loan out for, and you have subcontractors or contractors doing the work. Then you have project number 2 over here that you also took a loan out. So let's say you got $200,000 here, $150,000 here. Project number 3, you have $300,000, and you have all of this cash. And cash is fantastic. Cash is the lifeblood of any business, especially a business that's in the construction and real estate space. However, cash hides a multitude of sins. And because the businesses that we are in are so cash heavy, it's very difficult. Well, you can go a long time without identifying that you have problems inside of your business. So if you're doing anywhere from, say, 2 to 10 projects a year, you might be churning a ton of cash through your real estate development company or through your fix and flip company, but you're not identifying the fact that you have profitability issues until your accountant at the end of the year sends you your tax return and says, hey, you didn't make any money. And then you look at it and say, well, what the heck? I had tons of cash flowing through my business. We did $1 million. We did $5 million. How did we not make any money? And it's because of, well, it's 2 things really, but the first thing is tracking your work in progress. It's a super boring accounting term. It's called WIP for short. But tracking that work in progress allows you to look at every single job that you have going and see exactly how much has been drawn against the construction loan and how much has been paid to your subcontractors. Because what happens is, when we have, for the sake of this example, these 3 projects, project 1, 2, and 3, all going, and they're each pulling in a gross amount of like $200,000 in construction loans, all 3 of them are dumping cash into your checking account. But what we don't do, and what I see over and over guys not doing, is actually tracking what has been paid on that job and what still needs to be paid. So on project A over here, maybe you've pulled in $100,000 in construction draws, but you've only paid $50,000 of construction costs. So what it's going to look like is, it's going to look like you have an extra $50,000 in your bank account, and that $50,000 is not yours. It's actually a liability inside of your business. So if you're tracking WIP will tell you how much has been pulled in, how much is yet to be paid, and what is the gross profit based on the current stage of the project. And again, it's not sexy, it's not overly exciting, but tracking this WIP number, because at the end of every month, you are going to make a WIP adjustment inside of your business. And that's going to tell you what that liability is, because if you've overdrawn money, it is now a liability existing in your company. And if you haven't drawn enough, then it's beneficial to your company, because it means you have other cash that you can pull in. But the real sweet spot is to keep it balanced, to keep that WIP number at a 0 or very close to a 0. So tracking it across every active project that you have, it is crucial, because otherwise you're looking at your bank account. I was talking to the accounting department for a large real estate development firm 2 weeks ago, or last week. And the girl was telling me how happy she was. The girl in accounting was telling me how happy she was because she had $100,000 in the bank to pay subcontractors for that week. And it's just the wrong metric. Like, the cash that you have on hand is irrelevant, Because if it's the bank's cash, if it's the project's cash, if it's your subcontractor's cash, you cannot, you shouldn't be sleeping well at night thinking that you're doing well and that you're secure in your cash position. So you can go into greater detail by looking into this, but it's called a work in progress, and the monthly adjustment is called a WIPA, work in progress accounting adjustment. And you want to be doing that. And if you do not have this instigated in your business, I'm telling you right now, get it inside of your business, because at the end of the year, all throughout the year, you're going to see all this cash sitting in your bank account, but you never have any clue of what your true profitability is, because you don't know what cash you have on hand is yours and what belongs to the project. Get a WIPA process inside of your business today. And the second thing I see a lot of you guys doing is not factoring in your overhead as a percentage of profit. What I mean by that is, if you are doing, let's say, 2 house flips today, or let's say you're building a house, a spec house, and you're flipping a house, and you got a year on the build and 6 months on the flip, but you have a virtual assistant that you use, you have a small marketing team for your social media, you have an office administrator who handles the subcontractors with you, you have your accountant that you pay, you have your vehicle expenses, maybe you have a site supervisor who helps you manage some of the projects, but all of these costs are overhead costs. And the mistake the guys are making is, on the spec house over here, 12 months goes by and they clear $200,000. So they made $200,000 of profit on that build. And then over here on this flip, we made $80,000. So we think we made $280,000 for that 12-month period. And in reality, when you take the accountant into, you factor in the accountant, you factor in your time, because you should be being paid some type of salary. So your time, you factor in the gas and the fuel that you had, the vehicle expense, the site supervisor expense, the virtual assistant, all of these things, and all of these overhead costs that are essentially company costs, a percentage of overhead, you factor that in against that $280,000, and that might have been another $100,000 or maybe even $180,000. So you really only made $100,000 that year. But it's a mistake that I see repeatedly, because with investors, as they scale, they almost treat every single project as a business instead of their company as a whole, or their portfolio and their development company as a whole as a company. They treat it like this is a deal and this is a deal. And who cares if you made $200,000 off of one deal? Who cares if you made $80,000 off of one deal? Unless you're looking at your total overhead cost and you're factoring that into the profitability of every active job you have. It's especially dangerous once you start going from 1 or 2 a year to like 5 to 10 a year. If you're not factoring in that increase in overhead, you don't know definitively that you are actually even making a profit. And you would be shocked by the amount of people that I work with who are actually either breaking even or losing money. I'm talking guys who are doing many millions of dollars worth of development projects, all the way up to 10, 20, $30 million a year in development, and are virtually breaking even because they're not tracking their WIP, so they never know their cash position and they never know their true profitability, and they're not tracking their overhead against their individual deals or their individual work in progress. Those 2 factors. I'm telling you guys, if you start doing that, it'll be a game changer. If you are doing it, good for you. You were in the minority. You were in the 7% of real estate investors who are actually doing that. Because it's not just real estate investors, it's construction companies too. Almost no construction companies are doing it correctly. And it's critical for both real estate investors and construction companies. I hope you got value out of this. I hope you're listening to me. This is a kind of a boring video, but I'm telling you, this is one of the most critical videos and one of the most important videos that I've ever made, because this is what puts businesses out of business. It's what put me almost out of business years ago. It almost put my brother out of business 2 years ago. I'm working with a company right now, a very large, $50 million plus company, who's teetering on the brink of going out of business because of this right here. Not tracking WIP and not factoring overhead as a percentage of profit. Hope this was valuable. If you got value, like the video, subscribe. See you on the next one.